Question 1. Which of the following statements is true regarding general obligation, GO, bonds? A. They are backed by the full faith and credit and taxing power of the issuing municipality. B. They are typically supported by user fees from a specific project, such as a toll bridge. C. Voter approval is generally not required for their issuance, as they are self-supporting. D. Their debt service is paid solely from the revenues generated by the facility they finance. Answer. A. They are backed by the full faith and credit and taxing power of the issuing municipality. General obligation, GO, bonds are secured by the full faith and credit and taxing power of the issuing municipality. This means that the issuer pledges its ad valorem, property, taxes and other general revenues to repay the debt. Unlike revenue bonds, which are paid from project revenues, GO bonds require voter approval because they obligate the general tax revenues of the community. Question 2. An investor in a high federal income tax bracket purchasing municipal bonds would primarily be concerned with which of the following calculations to compare returns with taxable investments? A. Nominal yield. B. Current yield. C. Yield to maturity. D. Tax equivalent yield. Answer, D. Tax equivalent yield. While nominal yield, current yield, and yield to maturity are important measures of a bond's return, the tax equivalent yield is most relevant for investors in high tax brackets considering municipal bonds. This calculation helps determine the yield a taxable bond would need to offer to provide the same after-tax return as a tax-exempt municipal bond. For municipal bonds, which typically offer lower stated yields due to their tax advantages, understanding the tax-equivalent yield is crucial for making informed investment comparisons. Question 3. A state government passes a new law capping property tax increases for all municipalities within its borders. This action introduces which type of risk, primarily for holders of that state's general obligation bonds? A. Credit risk. B. Reinvestment risk. C. Legislative risk. D. Liquidity risk. Answer, C. Legislative risk. Legislative risk is the risk that a change in laws or regulations will negatively impact an issuer's financial condition or the value of its securities. A cap on property taxes directly limits a municipality's ability to raise revenue, which impairs the security of its general obligation bonds backed by that taxing power. While this could eventually lead to increased credit risk, the direct cause is a legislative action. Question 4. A municipal bond that is issued to finance a project, but the debt service is paid from a lease rental payment made by a state or city, is most accurately described as a A. General obligation bond. B. Revenue bond. C. Industrial development revenue bond. D. Moral obligation bond. Answer, B. Revenue bond. This describes a type of revenue bond, specifically a lease rental bond, where the debt service is secured by lease payments made by a governmental unit. While it has some characteristics that might seem GO-like due to the state/city payments, it is not a direct pledge of taxing power. True general obligation bonds are backed by the issuer's full faith, credit, and taxing authority, making this a form of revenue bond. Question 5. Under MSRB rules, a municipal bond dealer must disclose all material information to a customer at or before confirmation. Which of the following is not typically required to be disclosed for a principal transaction? A. The bond's rating. B. The yield to worst, e.g., yield to call or yield to put, if applicable. C. The commission equivalent or markup charged by the dealer. D. Any put or call features that may affect the bond's maturity. Answer, C. The commission equivalent or markup charged by the dealer. MSRB Rule G-15 requires dealers to disclose all material information, including the bond's rating, yield to worst, and any call or put features, to customers at or before confirmation. However, for principal transactions where the dealer sells from its own inventory, MSRB rules generally do not require disclosure of the dealer's specific profit or markup on the trade. Question 6. Which type of municipal bond would likely require an official referendum or voter approval for its issuance? A. Airport revenue bond. B. Sewer system revenue bond. C. General obligation bond. D. Hospital revenue bond. Answer: C. General obligation bond. General obligation, GO, bonds are backed by the full faith and credit and taxing power of the issuing municipality. Because they rely on the general tax revenues and can increase the tax burden on residents, their issuance almost always requires voter approval or a referendum. Revenue bonds, which are self-supporting from specific project revenues, usually do not require voter approval. Question 7. A bond counsel's legal opinion for a municipal bond issue primarily addresses the bonds. A. Marketability and liquidity. B. Credit rating and financial stability of the issuer. C. Tax-exempt status and legal enforceability. D. Yield to maturity and call provisions. Answer: C. Tax-exempt status and legal enforceability. The bond counsel's legal opinion is a critical document that confirms two key points. First, that the bonds are legally issued and enforceable obligations of the issuer, and second, that the interest paid on the bonds is exempt from federal income taxes. The opinion does not assess marketability, credit rating, or yield, but rather the legal soundness and tax status, which are fundamental to the bond's value. Question 8. Which of the following is most accurate regarding the tax treatment of interest income from municipal bonds? A. Always exempt from federal, state, and local taxes. B. Exempt from federal income tax, but may be subject to state and local taxes. C. Subject to federal income tax, but exempt from state and local taxes. D. Generally subject to the alternative minimum tax, AMT. Answer: B. Exempt from federal income tax, but may be subject to state and local taxes. Interest income from municipal bonds is generally exempt from federal income tax. However, it may be subject to state and local income taxes unless the investor is a resident of the state where the bond was issued. While some private-purpose municipal bonds may be subject to the alternative minimum tax, AMT, it is not a general rule for all municipal bonds. Question 9. A net direct debt calculation for a municipality would exclude: A. General obligation bonds. B. Tax anticipation notes, TANs. C. Self-supporting debt like revenue bonds. D. Overlapping debt from contiguous municipalities. Answer: C. Self-supporting debt like revenue bonds. Net direct debt is a measure of a municipality's own debt that is supported by its general revenues. It is calculated by taking the municipality's total direct debt and subtracting any self-supporting debt, like revenue bonds, and sinking fund accumulations. Overlapping debt is debt of other government entities that share the same tax base and is analyzed separately. Question 10. A qualified legal opinion accompanying a municipal bond issue indicates that: A. The bond counsel has given unconditional approval to the issue. B. There are some legal or tax uncertainties regarding the bond issue. C. The bond is secured by collateral beyond the issuer's full faith and credit. D. The bond is suitable only for institutional investors. Answer: B. There are some legal or tax uncertainties regarding the bond issue. A qualified legal opinion means that the bond counsel has found some legal or tax issues, conditions, or potential uncertainties concerning the bond issue. This is in contrast to an unqualified legal opinion, which gives a clean, unconditional affirmation of the bond's legality and tax status. A qualified opinion signals a potential risk to investors. Question 11. An investor buys a municipal bond in the secondary market at a discount. If the bond is held to maturity, how is the accreted discount treated for tax purposes? A. Taxable as ordinary income. B. Tax-exempt interest income. C. A long-term capital gain. D. A tax-free return of principal. Answer. A. Taxable as ordinary income. When a municipal bond is purchased at a discount in the secondary market, the discount must be accreted annually. This accreted amount is considered market discount and is taxed as ordinary income in the year the bond is sold or matures. This tax treatment is different from an original issue discount, OID, bond, where the accreted discount is treated as tax-exempt interest income. Question 12. Which of the following would not be found in an official statement for a new municipal bond issue? A. The legal opinion. B. The underwriter's spread. C. Financial statements of the issuer. D. The schedule of maturities and call features. Answer. B. The underwriter's spread. The official statement, OS, is the primary disclosure document for a new municipal bond issue, containing comprehensive information about the issuer, the bonds, and the legal opinion. However, the underwriter's spread, which is the compensation earned by the underwriting syndicate for selling the bonds, is not disclosed in the official statement. Question 13. A municipal bond that is rated BA by Moody's is considered A. Investment grade. B. Speculative, junk bondy. C. High grade. D. In default. Answer. A. Investment grade. A bond rated BA by Moody's, or BBB by S&P/Fitch, is considered the lowest tier of investment grade ratings. Bonds rated BA 3/BBB and above are generally considered to have adequate capacity to meet financial commitments. Ratings below this level are considered speculative or junk bonds. Question 14. Which type of municipal bond would most likely be associated with a private purpose bond and potentially subject to the alternative minimum tax, AMT? A. General obligation bonds funding public schools. B. Revenue bonds funding a public wastewater treatment plant. C. Bonds issued by a municipality to build a new professional sports stadium for a private team. D. Public power system revenue bonds. Answer. C. Bonds issued by a municipality to build a new professional sports stadium for a private team. Private purpose bonds, also known as private activity bonds, are issued by municipalities but primarily benefit a private entity. Interest from certain private purpose bonds, such as those financing a sports stadium or an industrial park, may be subject to the alternative minimum tax, AMT. Bonds for essential public purposes are typically not subject to AMT. Question 15. A municipal bond with a par value of $5,000, paying 4% interest, and callable at 102, means the issuer can call the bond at A. $5,000. B. $5,020. C. $5,100. D. $5,200. Answer. C. $5,100. A call price of 102 means the issuer can redeem the bond at 102% of its par value. For a bond with a $5,000 par value, the call price is calculated as $5,000 102, which equals $5,100. Call provisions are important features that allow the issuer to redeem bonds before maturity, typically when interest rates have fallen. Question 16. Which of the following is responsible for creating rules for municipal securities brokers and dealers, but has no enforcement powers over issuers? A. The Securities and Exchange Commission, SAC. B. The Financial Industry Regulatory Authority, FINRA. C. The Municipal Securities Rulemaking Board, MSRB. D. The Government Accountability Office, GAO. Answer, C. The Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is the self-regulatory organization, SRO, responsible for establishing rules for municipal securities brokers, dealers, and advisors. The MSRB does not have enforcement powers. Its rules are enforced by FINRA and the SEC. The MSRB also has no regulatory authority over municipal issuers. Question 17. An investor who purchases a municipal bond in the secondary market at a premium must consider the tax treatment of the premium. For tax purposes, this premium must be A. Amortized over the life of the bond, reducing the cost basis. B. Expensed in the year of purchase, reducing taxable income. C. Ignored, as municipal bond interest is tax-exempt. D. Treated as a capital loss at maturity. Answer. A. Amortized over the life of the bond, reducing the cost basis. For municipal bonds purchased at a premium, the premium must be amortized over the remaining life of the bond. This annual amortization reduces the bond's cost basis but does not create a tax deduction. If held to maturity, the cost basis will equal the par value, resulting in no capital loss. This mandatory amortization is important for accurately calculating the cost basis for tax purposes if the bond is sold before maturity. Question 18. Which type of municipal bond might be backed by specific assets like real estate taxes, but only up to a certain percentage or within specific boundaries, rather than the full taxing power of the municipality? A. General obligation bond. B. Special assessment bond. C. Lease revenue bond. D. Moral obligation bond. Answer, B. Special assessment bond. Special assessment bonds are issued to finance public improvements, and their debt service is paid by assessments on the properties that directly benefit from those improvements. For example, a bond to install new sidewalks would be repaid by property owners on that street, not the general tax base. This distinguishes them from GO bonds, which rely on the full taxing power of the issuer. Question 19. When comparing two municipal bonds, bond A yielding 4.0% and bond B yielding 4.5%, an investor in the 30% tax bracket needs to calculate the tax equivalent yield. What is the tax equivalent yield of bond A? A. 2.8%. B. 4.0%. C. 5.71%. D. 6.43%. Answer, C. 5.71%. The tax equivalent yield, TEY, is calculated as municipal yield / 1, investor's tax bracket. For bond A, the TEY equals 0, 0.40 / 1, 0.30 equals 0, 0.40 / 0.70 equals 0, 0.5714, or 5.71%. This means a taxable bond would need to yield 5.71% to provide the same after-tax return as a 4.0% tax-exempt municipal bond for someone in the 30% tax bracket. Question 20. A municipality's unfunded pension liability would primarily affect the credit analysis of which type of bond issued by that municipality. A. General obligation bonds. B. Airport revenue bonds. C. Toll road revenue bonds. D. Sewer system revenue bonds. Answer. A. General obligation bonds. Unfunded pension liabilities represent a significant financial obligation that draws on the general funds of a municipality. Since general obligation, GO, bonds are backed by the full faith and credit of the issuer, substantial pension liabilities can negatively impact the municipality's ability to service its GO debt. Revenue bonds, which are repaid from specific project revenues, are less directly affected by the issuer's general financial health. Question 21. Which of the following describes a take-or-pay contract often associated with municipal revenue bonds? A. An agreement where the bond issuer agrees to take on more debt if revenues fall short. B. A contractual agreement where a party agrees to pay for a project's output whether or not it uses the output. C. A contract allowing bondholders to take collateral if the issuer fails to pay interest or principal. D. An agreement for the issuer to pay off bonds early if revenues exceed projections. Answer. B. A contractual agreement where a party agrees to pay for a project's output whether or not it uses the output. A take-or-pay contract is a strong credit enhancement for certain revenue bonds. Under this agreement, a financially sound entity commits to pay for the output of a project, like water or power, whether or not they actually use it. This provides a guaranteed revenue stream for the bond issuer, significantly enhancing the security of the bonds. Question 22. Regarding the statutory debt limit for a municipality, which of the following is true? A. It applies primarily to revenue bonds. B. It can only be changed by federal legislation. C. It is a legal maximum amount of GO debt a municipality can incur. D. It limits the amount of short-term debt a municipality can issue. Answer. C. It is a legal maximum amount of GO debt a municipality can incur. A statutory debt limit is a legal restriction, typically set by state law, that specifies the maximum amount of general obligation, GO, debt an issuer can incur. This limit is imposed to prevent excessive borrowing that could strain the municipality's taxing power. Debt limits generally apply to non-self-supporting debt, GO bonds, and do not apply to revenue bonds. Question 23. A term bond issue would typically feature A. All bonds maturing on the same date. B. Bonds maturing annually or semi-annually over a period of years. C. Bonds that can be called only at par value. D. Bonds that pay interest only at maturity. Answer. A. All bonds maturing on the same date. A term bond issue is characterized by all the bonds having the same maturity date. In contrast, a serial bond issue has bonds that mature in installments over a period of years. Term bonds are often issued with a sinking fund provision, where the issuer sets aside money periodically to retire a portion of the bonds or the entire issue at maturity. Question 24. Which type of revenue pledge provides bondholders with the strongest security because debt service is paid before operating expenses? A. Net revenue pledge. B. Gross revenue pledge. C. Modified net revenue pledge. D. Funds flow revenue pledge. Answer. B. Gross revenue pledge. A gross revenue pledge provides bondholders with the strongest security because debt service payments are made directly from the gross revenues generated by the project, before any operating and maintenance expenses are paid. Under a net revenue pledge, debt service is paid after operating and maintenance expenses, making it slightly riskier for bondholders. Question 25. A city is experiencing a temporary cash flow shortage while waiting for its semi-annual property tax collections. To cover current operating expenses, it would most likely issue A. General obligation bonds. B. Tax anticipation notes, TANs. C. Bond anticipation notes, BANs. D. Revenue bonds. Answer, B. Tax anticipation notes, TANs. Tax anticipation notes, TANs, are short-term municipal notes issued to finance current operations in anticipation of future tax receipts. They help municipalities manage cash flow imbalances throughout the year. This distinguishes them from bond anticipation notes, BANs, which are for capital projects, and long-term bonds, which are not used for short-term operating expenses. Question 26. An investor living in New York City purchases a municipal bond issued by the state of New York. This investor would typically receive which of the following tax benefits? A. Federal tax exemption only. B. Federal and state tax exemption only. C. Federal, state, and local tax exemption. D. No tax exemption, as it's a private purpose bond. Answer, C. Federal, state, and local tax exemption. An investor purchasing a municipal bond issued by their own state and municipality typically receives the triple tax exemption. This means the interest income is exempt from federal, state, and local income taxes. This is a significant advantage for residents of high-tax states and localities and is a key selling point for in-state municipal bonds. Question 27. A municipal bond analyst is concerned about overlapping debt. This refers to A. The total amount of debt issued by the municipality, including short-term notes. B. Debt shared by different governmental units that draw from the same tax base. C. Debt that has been restructured multiple times due to financial distress. D. Debt issued by private entities but guaranteed by the municipality. Answer, B. Debt shared by different governmental units that draw from the same tax base. Overlapping debt refers to the debt of other governmental units that are located within the same geographical boundaries and have the power to levy taxes on the same residents, e.g., a city, a county, and a school district. Analyzing overlapping debt is crucial for assessing the total tax burden on residents and the overall creditworthiness of a municipality's GO bonds. Question 28. Which of the following is a primary risk for an investor in a callable municipal bond? A. Credit risk, as the issuer might default more easily. B. Inflation risk, as the purchasing power of interest payments may decrease. C. Reinvestment risk, especially if interest rates fall. D. Market risk, due to general fluctuations in interest rates. Answer, C. Reinvestment risk, especially if interest rates fall. The primary risk specific to a callable bond is reinvestment risk. When interest rates decline, issuers are likely to call their bonds to refinance at a lower rate. This forces the investor to reinvest the return principal at lower prevailing interest rates, potentially reducing their future income. Question 29. Which of the following best describes the purpose of a bond anticipation note, BAN? A. To provide long-term funding for major capital projects. B. To provide interim financing for a municipality that expects to issue long-term bonds. C. To finance current operating expenses in anticipation of future tax revenues. D. To fund projects that will generate their own revenue for repayment. Answer, B. To provide interim financing for a municipality that expects to issue long-term bonds. Bond anticipation notes, BANs, are short-term municipal securities issued to obtain interim financing for capital projects that will eventually be funded by a larger, long-term bond issue. They allow the municipality to start a project before the long-term bonds are sold, and they are repaid from the proceeds of that subsequent long-term bond sale. Question 30. MSRB Rule G37 is primarily designed to prevent which unethical practice in the municipal securities industry? A. Churning of customer accounts. B. Unfair pricing of municipal bonds. C. Pay-to-play schemes involving municipal finance professionals. D. Unauthorized trading in customer accounts. Answer: C. Pay-to-play schemes involving municipal finance professionals. MSRB Rule G37 is a critical rule designed to prevent pay-to-play practices. It restricts municipal securities firms and their professionals from making political contributions to officials of an issuer with whom the firm does business, with the intent to influence the awarding of underwriting business. Violations can result in a 2-year ban on doing business with that issuer. Question 31. A municipal bond offering with competitive bids typically means that A. The issuer works with a single underwriter who negotiates the terms. B. Multiple syndicates submit sealed bids to the issuer, and the lowest interest cost wins. C. The bonds are sold directly to institutional investors without an underwriting syndicate. D. The issuer sets the interest rate and underwriters compete to sell the bonds fastest. Answer: B. Multiple syndicates submit sealed bids to the issuer, and the lowest interest cost wins. In a competitive bid offering, multiple underwriting syndicates submit sealed bids to the issuer, specifying the interest rates and price at which they will purchase the bonds. The issuer then awards the bonds to the syndicate offering the lowest net interest cost. This method contrasts with a negotiated offering, where the issuer works with a single underwriter to determine terms. Question 32. Which of the following is considered a double-barreled municipal bond? A. A general obligation bond with an additional guarantee from a private corporation. B. A revenue bond also backed by the full faith and credit of the municipality. C. A bond that provides both federal and state tax exemptions. D. A bond issued by 2 different municipalities for a joint project. Answer: B. A revenue bond also backed by the full faith and credit of the municipality. A double-barreled municipal bond is a revenue bond that carries an additional pledge of the issuer's full faith, credit, and taxing power. This provides 2 sources of repayment: the project's revenues and the municipality's general tax revenues. This dual backing enhances the bond's security and generally leads to a higher credit rating than a pure revenue bond. Question 33. A sinking fund provision associated with a municipal term bond issue would primarily benefit A. The issuer, by reducing its overall borrowing costs. B. The bondholders, by ensuring an orderly repayment of the debt. C. The bond underwriters, by simplifying the distribution process. D. The municipal taxpayers, by eliminating future debt service obligations. Answer: B. The bondholders, by ensuring an orderly repayment of the debt. A sinking fund provision requires the issuer to make periodic payments into a separate fund, which is used to call bonds or purchase them in the open market. This systematically retires the debt over time, primarily benefiting bondholders by reducing the risk of a large balloon payment default at maturity and thus enhancing the bond's credit quality. Question 34. What is the primary purpose of a preliminary official statement, POS, in a new municipal bond issue? A. To finalize the bond terms and obtain legal opinions before public sale. B. To gauge investor interest and provide information to potential bidders. C. To serve as the definitive disclosure document for investors after the bonds are sold. D. To list the final pricing and allocation details to the underwriting syndicate. Answer B. To gauge investor interest and provide information to potential bidders. A preliminary official statement, POS, or red herring, is used by underwriters to gauge investor interest during the pre-sale period for a new municipal bond issue. It contains most of the information that will be in the final official statement but lacks final pricing details. It provides potential bidders in a competitive sale with the necessary information to formulate their bids. Question 35. When assessing the credit risk of a revenue bond, an analyst would place the least emphasis on A. Debt service coverage ratio. B. Feasibility studies of the project's economic viability. C. Covenants within the bond indenture, such as rate covenants. D. The ad valorem tax base of the municipality. Answer D. The ad valorem tax base of the municipality. Revenue bonds are secured by the revenues generated by the specific project they finance. Therefore, credit analysis focuses heavily on the project's ability to generate sufficient income, measured by debt service coverage ratios, feasibility studies, and protective covenants. The ad valorem, property, tax base of the municipality is the primary security for general obligation bonds and has little relevance for the repayment of a pure revenue bond.